All right, so Jeremy Porter, let's talk about this new information just released from you guys at First Street Foundation. So let's start with a little background here on wildfires. Can you tell me what the trends have been here with wildfires in recent years?
Yeah, wildfire across the country is the fastest growing climate hazard in regard to both the exposure to individual residential properties and communities, but also in terms of the cost associated with the climate exposure. We're seeing some of the trends associated with, acreage burned going up by about 68% over the last 10 years. But in that same time period, we've seen an increase in cost of suppression and firefighting for these wildfires go up almost 4 times. So we're spending a lot more money on fighting these wildfires, but we're still seeing more and more acres burned. And what that's done is actually translated to a lot of cost increases. Since about 2016, we've gone from about $2 to $3 billion a year in terms of wildfire damages up to a peak of around $17 billion just a couple of years ago in 2022. And concurrently with that, we've seen structures destroyed increase. So it's not only that we're having more acres burned, we're spending more money fighting these fires, but the wildfires are happening in places where people live now more often. And because of that, we're seeing these costs skyrocket.
Okay, so let's talk about the insurance cost. Because I'm with you, I have a science background, so I don't know too much about insurance, but from reading your report, it seems that insurance companies are dropping people who are in high-risk areas. Is that true?
Yeah, the insurance companies are in a tough spot in a lot of these states. So insurance companies in California, for instance, they're part of what's called the FAIR plan there, which is designed to make sure that there's affordable insurance or at least some type of an insurance option for anybody in the state. The biggest problem with that for insurance companies today is that there's a lot of policy regulations around what they're able to do, what they're able to price in regards to their premiums. So they're being hit with these restrictions around only looking at backwards facing risk, not looking at climate change as it moves into the future, not taking single homes into account, but instead taking into account the entire portfolio. And the biggest way to kind of think about the impact that this is having on their ability to price risk properly is that there's an imposed 7% cap on how much they can raise premiums year over year. And so we did a little bit of the math around that 7% cap. And even if you started out with like a $2,000 policy annually, you increased it 7% year over year for 13 years, you would still be about $3,000 short of the actual risk premium that exists in some of these places.
Okay, so you get dropped by your insurance. What's the backup? You just don't have insurance?
So because of the fact that these insurance companies are pulling out, the states have built sort of these insurers of last resort. They're the insurance companies that exist in these states for people to find insurance. Unfortunately, most of the time that insurance is priced pretty high because it does take into account the climate risk. That was exactly the reason why the voluntary market insurance companies dropped those premiums in the first place. So people, they get a non-renewal notice. They'll go to the insurer of last resort. As they go to that insurer of last resort, they get the sticker shock. All of a sudden, their insurance premiums go up by like 2-3 times what they were paying previously.
Okay, so we've got maybe some different types of people too who are dealing with this. I'm guessing, there's people who can afford maybe the premium, can afford to maybe leave their house, take a hit, move somewhere else. But what about people who can't afford that, who are kind of stuck in somewhere like California or Florida or Louisiana, and they cannot afford to leave, or it's a family property that they've been on for generations? What's the solution there? They're just out of luck?
Yeah, it's a really tough question. I mean, there are certainly people that, want to live on the coast. We know there's a lot of hurricane risk along the coast in Florida. There's also a lot of amenities. People want to live there. They want to be close to the water. And so some people are willing to pay for the amenities, and they'll do that through risk transfer mechanisms like insurance. The problem comes, as you mentioned, some folks just don't have the economic means to absorb another, 2 or 3 times their old insurance premium cost. It just adds to their homeowner's cost and sort of the cost burden of that home ownership. What we're seeing is that effectively when you get one of these letters and you see that your insurance is not being renewed by the insurer, all of a sudden you have to go to this insurer of last resort. You're seeing this increase in price premiums. That has a direct impact on property values. It may not be realized right away, but when you go to sell the house, the people that are buying the house are going to take into account the fact that, oh, this house also has an additional $3,000 in insurance annually that wasn't accounted for previously. So we're seeing these dynamics play out in the property market.
All right. Well, this is depressing. So tell me what the purpose of this information coming from First Street is. What are you hoping to get from this?
We've done some research around, potential overvaluation of properties around the country due to kind of unknown risk. We really started in the flood space, and we found that, about 50% of all of the risk in the country is unknown. It's not public facing in the FEMA maps just because of the ways in which those models are developed. And when you actually price those in, some of our research shows that being zoned into a flood zone immediately drops property values by about 4% of the property. And then there's this carry-on effect also associated with that. So our goal really in producing this research is that we wanted to try to quantify, what is this climate bubble that's starting to emerge? We're already seeing people have to go into the FAIR plan in California, or the Citizens insurance plan in Florida and Louisiana, which is their insurer of last resort. But there's another, 35 million or so properties across the country that are at risk of having some kind of an insurance related correction to their property values. And that, just sort of said a different way, about a quarter of the properties across the country are at risk of being in this insurance climate bubble.
So you guys have these climate models that anybody can look at online. They can put in their address, see what their risk is. And, information is power. Maybe they choose not to buy a property because of that. But do you ever worry that this information is also going to get into the hands of the people that can use it against them? Are the insurance companies looking at your climate model risk factor information and saying, okay, well, let's knock that person off the list?
One of the really interesting things is we started to do this research. We downloaded a bunch of work from California State on sort of their documentation of insurer non-renewals. And our wildfire model aligns really well with what they've been doing for the last 7 or 8 years. So they have this data. They know where the risk is located, and they're starting to pull out. The problem is that there's a lot of this education happening within the insurance industry, but the public's not being informed of the risk. So our role really in this sort of ecosystem is to create the kind of highest quality property level, high resolution data, make it available to individuals so they can make informed decisions. With that data, communities can use it to better understand how to kind of efficiently allocate resources to different parts of the community. To your point, maybe you are going to take into account different socioeconomic standing of different neighborhoods when you want to make those decisions. So there's lots of different ways in which the data can be used, but we feel like we plug into the pipeline as the data providers.
Gotcha. Okay. And, I'm curious your opinion with your science background on wildfires themselves, because I interviewed recently a smoke jumper, which is super cool job. But he's been doing this for so long, and he had all these thoughts that he was saying about, we've stopped too many of the fires, and now it's created a bigger problem. So what are your thoughts on that?
Yeah, I mean, that's a really good point. If you dig into the fire science, the fires sort of regulated themselves for millions and millions of years because they burned off fuel, and there wasn't as much fuel available for wildfires. We've been suppressing these fires for so long because we are building. We're building in places in the WUI. We're building out in rural areas. We're building in places where fires traditionally occurred. But by doing that, we're building up the fuels. And when you build up the fuels, a drought comes along, a hot summer comes along, all that fuel dries out, and it just becomes a driver for the wildfire. So we are contributing to the wildfires through processes of suppression.
All right, Dr. Jeremy Porter, thank you for all this information. Is there anything else you want to share coming out of this report that we should know about?
Now, we always like to end, we're a nonprofit. We want to quantify and communicate this risk. We always like to end by saying this data is available on Risk Factor. Anybody can go in, type in their address, and understand their own personal climate risk.
Hey, thank you so much for watching. While you're here, check out some other videos you just may like.